Hi, this is Steve Erdman with EFG Group and International Futures Group here in Chicago. I'd like to talk to you today about a couple of potential spread opportunities that involve the cattle market. Cattle have been very strong as of late. Today, April cattle traded up at 162.77 as of this filming, and they're still open, so we've got a little bit of trade left. But there's a couple of things in the cattle market that I think bear watching. As you see from this first chart, I made these trend lines and these different projections back on February 11th, and I think we're in a resistance zone right now. So either the cattle market, as this April contract is into expiration in the month of April, June will take over, and June is right now trading at about a $9 discount to April. So June cattle are trading around 153 to 154. The Feb contract, just to put things in perspective for you, was trading at 158.32 when I made this first weekly live cattle chart. April cattle were trading at 151.10, so we're a good $11 higher in a little less than 2 months' time. The first thing I think you should look at as we go to the next chart is a corn-cattle ratio. I would like to be long corn and short cattle right now in some way, shape, or form. I'm showing you this weekly chart to give you an idea of what I'm looking at technically. There's a V-bottom that we made back in the fourth quarter of last year, and now the market is down flagging. Again, the chart you're looking at here is a weekly continuation that's based on the April futures. And I think this, with a little bit of effort on the market's part, will start to look pretty decent, being long corn and short cattle. As you can also see on this ratio chart, I did a 2:6 ratio. That's really typical of the forward cattle crush spread. These are two components of a forward cattle crush. To make it a full cattle crush, you would also buy 2 contracts of feeder cattle. And typically you buy the nearby corn and the nearby feeder cattle and sell the deferred live cattle contract that's 6 or 8 months out to have an effective hedge on your cattle feeding operation. But the point of this is to show you the overall picture in the big picture and how I think it deserves some attention. I really would strongly recommend that you talk to your broker before you get into this, because it's kind of complex. You can do 1-to-1, you can do 2-to-6. There's many different ways to put this on, and you really need to have a full conversation with your broker. But most importantly, if this spread starts to weaken again and show new low close as we had back in October, you need to be out. I mean, this is very risky trades, and the cattle market's been on a tear for a number of years because of our inventory issues here in the United States, and it's just very important that you manage your risk. The next strategy is a little bit more straightforward, a little bit more simple. It's a cattle hog spread. And this is a technical read once again. As you see, as I've outlined on the chart, we have what appears to be an island top in place at the moment. This is based on the June contracts. June cattle have rallied up to just over 80 cents. I think 80.15 was a high. And again, to put things in perspective for you, the April contracts, the current April contracts, got as high as $104.55 cattle premium to hogs. So obviously, again, there's a tremendous amount of risk in this. My recommendation is to fade this uptrend because of this island top and the flagging action we've had in the last several days. If the market closes below the low we made yesterday on Wednesday at about 75.85, I'll think you'll want to add your position. But for the time being, I would recommend buying June hogs and selling June cattle. And the most important part of this strategy is, once again, making sure that you're managing your risk and closing out the position if we close a new high ground above 80.17. Call your broker for further details. Good luck. Have a happy Easter.